My name's Schaefer. I'm, along with Anna and Richard, I'm one of the academic directors of the AQR Asset Management Institute at London Business School. And we're turning now to the E in ESG, which particularly to climate, which you'll need no persuading is one of the most important risks facing the world and possibly existential. And we're extremely happy to be joined for this session, as Anna told you earlier, by Martin Skancke, who is the chair of the board of the Principles for Responsible Investing, known as PRI. And he's also a member of the Financial Stability Board Task Force on Climate-Related Financial Disclosures, known as the TCFD. And also in his distinguished career, he headed up the Asset Management Department of the Norwegian Ministry of Finance, which is responsible for the Norwegian Sovereign Wealth Fund, the government pension fund, which also was an early leader in issues to do with responsible investing and indeed with climate-related issues. So over to you, Martin. Thank you.
Thank you so much. Thank you for the invitation, and I'll try to see if I can share my slides with you. So thank you for the invitation to talk to you today about this very important topic. And I thought I would go through some of the work that also just mention some of the work of the PRI. Maybe it's useful by way of sort of general introduction to say just a few words on the PRI itself. We're an organization of institutional investors. We now have more than 3,600 signatories in about 70 countries, managing well over $100 trillion of assets. We ask our signatories every year what they want us to focus on. And for the last few years, climate change has been on the top of that list. So this is certainly an issue that many investors now care about. I think any discussion of climate change really has to start with the physical fact of CO2 emissions. This is a reconstruction of CO2 concentrations in the atmosphere over the last 800,000 years. And you don't need a degree in statistics to tell that there's been a structural break in this right around the time of the Industrial Revolution. Well, in fact, most of this change has occurred over the last 30 to 40 years. We've seen an extreme increase in the CO2 content of or concentration in the atmosphere. Scientists now tell us that the concentration is higher than it has been in at least 3 million years. And the change in concentration is, with a high probability, the fastest change ever in the history of the planet. And this has led to higher temperatures. We have just passed the point where we are outside the realm of historical experience for mankind, at least in sort of human civilization terms. So we have the highest temperatures now than we've had in at least 12,000 years. And there is a lot of inertia in the climate system. So even if we were hypothetically to end CO2 emissions tomorrow, the climate would continue to change over several decades. This necessitates the need for, it necessitates a rather significant transition away from fossil fuels and bringing emissions to net zero. This is because the temperature increase or the temperature levels is a function of the concentration of CO2 in the atmosphere. And so as long as we have positive CO2 emissions, we're increasing CO2 concentration and thus increasing temperatures. So to stabilize temperatures at any level, we need to bring net emissions down to zero. And so this is an example of a projection. Typically, these projections will, or these scenarios will give a net zero around 2050 as a condition for meeting the objectives of the Paris Agreement. And in historical terms, obviously, this is a very quick transition out of a dependence on fossil fuels that has built up over many decades. So this leads to two types of risks for investors, physical risks and transition risks. And so an important question for investors is then how to take these risks into consideration in their investment practices. And it's been realized also that this has potential consequences for financial stability. And this was the background, I think, for Mark Carney's initiative as chair of the Financial Stability Board to convene this task force. It was a link between climate change and financial stability. But I think in a wider sense, it has to do not with the risk of a financial crisis triggered by climate issues, but also in a broader sense, the well-functioning of financial markets. How can financial markets efficiently allocate capital in a market where there is this huge risk factor that in itself is a consequence of a market failure, or a failure to put a proper price on CO2 emissions. So this is really just the background, and then I thought I would spend some time on this slide, not to go through each individual question, but say a little bit about how we at the TCFD thought about setting out a framework for climate risk reporting. So this is the TCFD framework, which we published in the summer of 2017. As you can see, it's based on 4 pillars, so governance, strategy, risk management, and metrics and targets. It's useful maybe to start by considering how this framework is different from all the other climate-related reporting frameworks that are out there. We started our exercise at the TCFD by trying to identify all of the relevant climate-related frameworks that already were, and thinking about, well, how can we add value? What was sort of missing from the existing body of reporting frameworks on this issue? And I think, and I'm oversimplifying significantly, but I think if I were to sort of summarize very simply, most of the existing frameworks had an impact perspective, i.e., they were designed to say something about how companies affected the climate through their emissions. So it was, you could view that maybe as an accountability mechanism, trying to hold companies accountable for their contributions to climate change through their emissions. So there's a lot of focus on emissions reporting. At the TCFD, we thought that if you want to put this in a financial context, it's not really primarily about how companies affect the climate, but it's about how climate change and climate policies can affect companies financially. So we try to maintain those two perspectives, and you will see under metrics and targets, there are recommended disclosures around emissions. But that's not really the main focus of this reporting framework. The main focus is more on governance and strategy and how climate risk is part of the strategy process of companies. So the first question under governance is describe the board's oversight of climate-related risks and opportunities. And we found that to be a very natural place to start, because if you think that a company is going to make a necessary but not sufficient condition for a company to have good management of climate risk is that the board is engaged in these issues. But I wanted to spend a little time on the last question in the strategy column, where it says, describe the resilience of the organization's strategy, taking into consideration different climate-related scenarios, including a 2-degree or lower scenario. So this is a type of stress testing, if you like, trying to get an understanding of how robust or how resilient a particular company's strategies are in the face of climate risk. And if you were to translate this into plain English, you would probably say, please tell me how you will make money with your business model in a world that's successful in meeting our climate objectives. So that's a very powerful question to ask of, for instance, an oil and gas company. But in a wider sense, I think it reflects that we know that we need to make the transition from a carbon-based to a non-carbon-based energy system. That has to happen. What we don't know is the extent to which that transformation will happen through a transformation of existing companies or building down of existing companies and building up of new companies. So will the energy companies of the future be today's fossil fuel companies who have transformed themselves into leaders in renewable energy? Will tomorrow's automobile companies be today's companies who have transformed themselves into leaders in electric vehicles? Or will newcomers like Tesla and others take their place? And I think a reasonable answer to that question is that it'll probably be a mix of both. Some companies will be able to manage this transition, others will not. And a key question for investors is, of course, to try to make an informed judgment about who those companies are, which companies are able to make that transition. And that will affect how investors should think about things like capital structure, dividend policy. If you believe that a company is well placed to transform itself and make money in a low carbon economy, you'd be happy to let that company reinvest the money they're making today in their own business. But if you don't think that they would be able to transform themselves, you would try to constrain their capital spending, take out increased dividends, and reinvest that in other companies that you think are better positioned through this transformation process or the transition that we're going through. So we wanted this framework to really try to address some of these questions and be helpful for investors in filling that crucial role that they have in a market economy, which is basically facilitating efficient allocation of capital. So we thought that this would be a framework that was productive from the point of view of investors, give them useful information that they can use in their investment processes, but also from a more societal point of view, trying to make capital markets function more efficiently in the face of this new large risk factor and in the face of this energy transition process, and trying to make sure that we can allocate capital as efficiently as possible in this process and reduce as much as possible the risk of stranded assets. So I think there's, from a financial stability point of view, maybe two different risks here. One is sort of the more tsunami type risk, which is suddenly there's a repricing of assets, which leads to large capital flows, which might affect some financial institutions, and then you have sort of a domino effect through the financial system. Sort of these sort of cataclysmic type events, which is a natural focus of policymakers, or in particular for Financial Stability Board and other financial market supervisors. But there is another risk, which is more type erosion risk, which is not that we have some sort of cataclysmic climate risk event, but that we have a capital market that's inefficient and it doesn't allocate capital in a way that takes account of this climate risk. And it leads to inefficiencies in capital allocation, lower capital returns, and the accumulated effect of that over time can be quite substantial for institutional investors. So I think it's sort of in parallel to this sort of these sort of concepts from nature. Tsunamis are more sort of newsworthy, but over time, over long periods of time, landscapes are shaped by erosion more than anything else. And so I think that's sort of a very important framework for investors to have in the back of their minds when they think about these issues. They can be faced with risks that don't necessarily materialize in the sense of sort of big cataclysmic newsworthy events, but they can still have bear the costs over time of suboptimal returns, and the accumulated effects of that over time can be quite substantial. This, unsurprisingly, was very difficult for most people to do, and we were aware of that. We tried to issue guidance on this in 2017, but there has been demand for more guidance. So I just wanted to mention briefly that we put out in November some additional materials on scenario analysis, and also guidance on how to integrate climate-related risks into existing risk management processes. It's important to recognize that climate risk is just one of many, many risks, obviously, that any investor or any company is faced with. And we can't treat that as sort of a separate silo, distinct from and separate from other risks, but it has to be part of an integrated approach to risk management. And we have some thoughts on that, which is in this document. I'm not going through this, but just if you're interested, as I said, the PRI has been asked by, we've been asked by our signatories to do work in this area, and we're trying to support our signatories in, well, mainly two ways. One is support them in, as they are investors, support them in interpreting and integrating the reporting that they will get from the companies they have invested in their own investment process, but also trying to support them when they report according to the TCFD framework, because financial institutions really have these two hats on. They are users of reports, TCFD reports from the non-financial companies that they've invested in, but they're also preparers of TCFD reports to their stakeholders around climate risks in their own portfolio. So there are a number of different tools and guidelines, et cetera, on the PRI website. So I'll just mention that and direct you to that website. I wanted to mention one piece of work in particular that I think is important. We call it the inevitable policy response. I'm not so happy. I was never so happy with the name, because there's unfortunately nothing inevitable about a policy response to climate, but I'm only the chair, so no one really listens to what I have to say. But this is a work that we tried to come with as a supplement to a lot of the existing scenarios that were out there, in particular to the Ipcc scenarios. So if you'll recall, maybe I should just go back quickly. So the Ipcc scenarios look something like this. They have a sharp drop in net emissions, but it's a mix of a fall in gross positive emissions, and then lots, in some scenarios, quite significant amounts of negative emissions. Some of these are from known technologies like planting forests, and some of them are technologies that we don't have yet. And actually, these are just constructed by as a residual in many of these scenarios. We're just assuming that we will have negative emissions in the future. So we wanted to, and essentially these are calibrated by setting an endpoint like zero net emissions in 2050, and then rolling backwards into what a trajectory would look like. We wanted a scenario that was more forward-looking, which started today and then said, well, what if policymakers make significant changes in climate legislation, in carbon taxes, etc. And we tried to analyze the effects of a sudden policy change in around 2025, which is the next time we'll have a ratcheting up of commitments under the Paris Agreement. And we analyzed this through the simultaneous use of three models. One is a macroeconomic model for the world economy. One is an energy market model. And thirdly, and crucially, a model for land use, because land is really a bottleneck in all of these calculations. And in many of these scenarios that rely on huge amounts of negative emissions, you're just assuming that land would be available for planting of forests, for instance. Some renewable energy technologies are also very land intensive, like solar panels. And at the same time, you need to feed a growing population. And so there will be competition for land use. And in the model, we tried to take account of that. So this was trying to illustrate the effects of a scenario which had the properties of being close to or relatively close to a sort of 2-degree scenario, but instead of having this sort of smooth, gradual transition, it's a later and more abrupt transition, which will give probably a lot more challenges for financial markets and in terms of repricing of assets, etc. So I just wanted to mention this, and the model or the documentation of the model and the exercise, etc., is available on our website. I think this fits well in with some of the initiatives of, for instance, the so-called Network for Greening of the Financial System, which is a working group of central banks and financial market supervisors. And they are thinking about transition in 2 dimensions. One is sort of, are you meeting the climate objectives or not? And the other is it a smooth or an abrupt transition? And so it's possible that you can have a late but very forceful tightening of climate policy, and that the transition to a low carbon economy would play out very differently than if you had a much earlier and smoother transition. It's also possible that you could have sudden technological shocks that would trigger large capital movements, repricing of assets, etc. That could be significant also from a financial market stability point of view. So there are different scenarios, and I think for investors, it is important to try to consider something that goes beyond just sort of these smooth Ipcc scenarios. So it's not just about sort of the end point of the energy transition and then trying to draw a smooth line to get you there, but it's also trying to understand the risks of very late but very forceful tightening of policy and how robust are your investments in scenarios like that. So if you've invested in an energy company, and taking one of the most obvious sectors perhaps to discuss, it's useful, I think, to think about a company as sort of 2 things. It's a portfolio of underlying projects, and it is also at the same time a platform for accessing the value creation from those projects. So you invest in an oil company, which is sort of a platform, and then the company has invested in different projects. So I think for investors, then you have 2 questions. One is, what does a good portfolio of projects look like? What kind of projects, what kind of underlying exposures do you want in your portfolio? But you also need to understand what are the most efficient platforms for accessing those projects and understanding how this will play out at the company level. So naturally, you would ask questions like, will existing fossil fuel companies be the energy companies of the future? Some energy companies have now told their shareholders that they intend to become leaders in renewable energy and make that transition. Others have said, no, we'll stick to what we know best, which is fossil fuels. If you don't like that, you can invest in something else. So what should investors make of this? So I think it's fair to say that fossil fuel companies have at least some characteristics that could potentially be leveraged in the transition to a low carbon economy. So they have good engineers, project managers, they know the energy markets. There's been A lot of talk lately about offshore wind, for instance. So if you have a particular skill set in offshore oil drilling, you might have some skills that could be transferred and used as a platform for building a competitive advantage in those markets. But on the other hand, it's not really clear that these skills couldn't easily be replicated by other companies and newcomers. And I think one question that has come up more recently is, of course, whether there are sort of financial synergies or dyssynergies. And that comes back to this concept of an investment platform. Are investors really seeing a fossil fuel company as a relevant platform for investing in renewable energy? And should they do that? Or is it better for them to invest directly in dedicated investment platforms for those technologies? And so that, I think, requires more than just saying, just cheering on those companies who say that they will be active in the transition. And but it requires, I think, a critical mindset and trying to understand whether a fossil fuel company is a good home for these new technologies. Is it an efficient route for transforming the energy system? Will it take too much time to build down existing companies and build up new companies? Will that make the energy transition slower? That's possible. So I think these questions are questions that really are critical now for investors to ask, and understanding in this transition process, to what extent will we be transforming existing companies or building down existing companies, building up new ones? An alternative strategy for a fossil fuel company owner would be to put pressure on them to increase their dividends, constrain their new investments, and then take those dividends and reinvest in renewable energy accessed through other platforms than existing fossil fuel companies. And finally, all of this has, I think, led investors to come together in the way that we've never seen before. And if you're not familiar with this initiative, Climate Action 100+, this is an initiative that the PRI is organizing together with four other organizations, as you can see. And we've now gotten more than 500 institutional investors as part of this initiative. What this is a coordinated forum for ownership strategies, for engaging with companies. And we've identified, originally the idea was the 100 most polluting companies in the world. It's 100 plus now, so it's 160 or so companies from across the world. These 160 companies have a combined emissions corresponding to about 80% of total emissions in the world from the industrial sector. And the way we organize this is that we've chosen 2 or 3 investors from this group of 500 plus investors to engage with each of these 160 companies on behalf of the entire group on the same issues, but tailor-made, of course, to the circumstances of the individual company. So transition strategies, emissions reporting, climate risk reporting, etc. So TCFD reporting is one thing we're pushing for. And you will have seen that some companies like Shell, Equinor, others have come with new announcements of climate initiatives, announcing that they will target zero net emissions, etc. in the future. All of this is in large part, I would say, a result of the engagement from institutional investors through this cooperation. So this is a 5-year program. We're in the 3rd year now. So far, I would say that I'm very encouraged by the results. And then we'll see how we can take this further beyond the 5 years. But I just leave you with this, that I think there are lots of, or one of the issues that we're faced with here is that there's a big free rider problem engagements and corporate engagements. Everyone knows that it creates value, but you can be a free rider on other investors' efforts. And so bringing investors together in a forum like this is a strategy for us to try to reduce that free rider problem and to give investors a cost-efficient way of engaging on a very important topic. So I'll leave it at that. Thank you very much.
Thank you, Martin, very much indeed. No one, I think, is in any doubt of the importance of the things you're talking about. We have a lot of questions, and maybe we'll start with this one from an anonymous participant who says, "What are you looking to see from companies and governments on the transition to a low carbon economy in the next 5, 10, and 15 and 20 years?" And I might sort of add to the list of companies and governments, sort of particularly the investment management industry.
Yeah. Okay. So I think number one is the whole reason why we have a climate problem in the first place is a market failure in the pricing of carbon. So the Stern report, I think back in 2007, said this is the largest market failure in the history of mankind. And we haven't set a proper price on emissions. So I think that there is no amount of investor action that can compensate properly for that. That is a political issue, and governments have to address it. What I do think is that if governments get the policy right, the effects of that can be amplified through investor action. You need to use market forces. I think the TCFD is an example of a reform that tries to improve the working of capital markets by giving more relevant information, and so essentially improving the efficiency of the capital allocation process. I think the Climate Action 100 Plus is also an attempt to address or internalize some of the positive externalities of corporate engagements. But the basis of everything has to be policy. There is no way that we can solve this, I think, in time without stricter climate policies, and that is a political responsibility.
Yeah. I mean, a lot, as you've just mentioned, an awful lot of this is about carbon, but there's a question that says, you know, other important factors at play besides CO2 emissions, you know, these are, which are not talked about in the context of climate change and measurement of climate risk. So is it really entirely about carbon, or are there other things we need to worry about too?
Oh, there are many things we need to worry about in the world, but it's the source, you know, the primary. So it's carbon, and then it's methane, and there are some more potent climate gases that are not CO2 only. Methane emissions are important because they're very potent, but they're also pretty short-lived in the atmosphere. So they are relevant from a risk perspective in the context of the so-called tipping points. So the climate system can have some tipping points where you trigger self-reinforcing mechanisms. So one example is the polar ice caps melt, but they reflect a lot of heat because they're white and reflect, and when they melt, more heat is absorbed, so the heating process intensifies. The same with what's happening now in Siberia, where higher temperatures leads the tundra to thaw, and that biological process that are triggered, they release huge amounts of methane gas, which is a very potent climate gas, and that can sort of lead us beyond new tipping points. But the difference between CO2 and methane is that methane is broken down very quickly in the atmosphere, but it's still, whereas CO2 for practical purposes isn't. I mean, it takes thousands of years. So yes, it's not just CO2, but I think that's sort of where, or these these emission sources are very correlated. So if you address the CO2 problem in a proper way, you will also probably indirectly have solved a lot of the other problems.
The next question is links very much to the discussion in the last session. So the question is, can we rely on data and reports from companies and rating agencies on carbon emissions? Are they reliable and accurate? So how much is the problem of measurement here and observability and sort of truthfulness?
We can rely pretty much, I think, on so-called scope 1 emissions, which is the emissions that companies have from their own operations. But if you look at scope 3 emissions, which is sort of downstream emissions from sort of their customers' emissions, that's analytically very difficult to do in a good way, and there are many methodological issues. But I think from an investor point of view, as I said, I'm not even sure that present carbon emissions is necessarily a good indicator of climate risk at the company level. You could compare two power producers. One of them, and they can have similar emissions, but one of them has a credible, well-financed plan to gradually close down their coal-fired power plants and build new renewable capacity. The other doesn't. So just the CO2 emissions will not tell you that story. And the whole point of the TCFD was trying to get sort of a richer picture of those risks and put them more in a strategy context and make it more forward-looking in a sense, because these emissions data will always be backward-looking.
Yeah. We have, there's a question about upcoming European disclosure regulation. Okay, so what is your view on the upcoming European disclosure regulation that, according to this question, has 32 metrics?
Yeah. So I think this goes back to the discussions earlier about sort of reforms in corporate reporting and more in general. So I think there are some challenges here. We wanted the TCFD to be a global framework or something that could be applied globally. And we see it, I mean, it is a voluntary framework, but I think I would not be surprised if during the COP26 in Edinburgh that we would see moves to sort of formalizing this as a required framework. And things have maybe changed a little bit in the US context also after the elections. I think the challenge here with Europe is that on the one hand, they are maybe more ambitious in some of these areas, which is a good thing. But from an investor point of view, it has great value to have standardized global frameworks. Yeah. So if the EU rushes ahead to do their own things because they think the rest of the world is moving too slowly, we will have this divergence of frameworks. And for an institutional investor with a global portfolio, you want to make sure that there's comparability. So I think we haven't quite solved that question yet. And we see it now in the context of reform of the reporting systems, where there is an initiative. Well, we saw the IFRS institution had a consultation on whether they should make something which is more global and start with climate. I'm very, very positive to that. I think it's a natural home for a reporting framework in the longer term. Why do we even use the terminology financial and non-financial about these risks? I mean, climate risk obviously is a financial risk. So why wouldn't we have one reporting system aligned with sort of the IFRS and use that as a mechanism? But I think for the EU, the political reality is that that wouldn't be ambitious enough because you would require sort of consensus around this. So I think they are looking to go beyond that. So I think this is just that tension is there, and I don't think we have a good answer as to how we should resolve that.
Martin, Mark Cliff has a question that has the spirit of maybe what will happen if people sort of do too much rather than too little. And so he has, it may be rational for an individual investor simply to dump their brown assets.
Yeah.
But if all follow suit, this could be systematically dangerous by triggering a catastrophic collapse in asset prices of companies that we will still need during the transition. All right. How can we address this problem? I mean, do you think it is a problem? And if so, do we need to address it?
I think to some extent this is already happening. If you just look at how companies now have been repriced over the last few years, there are elements of this. I think it's more a question for academics who maybe to do studies on to what extent are forward-looking climate risk assessments is climate a price risk factor in financial markets? If you have the answer to that, please tell me. So, but yes, I think we've seen some repricing. Just looking at, for instance, dividend yields now, large US oil companies is around 10%. Obviously, these are trading at a discount relative to projected future cash flows. Whereas the implicit, expected returns from large renewable energy companies seem to be pretty low at the moment. So there's some elements of this already. I think this is, so two things on this. One is, so there is, a market mechanism with an equilibrium. When differences in expected return become large, then you would expect people to trade on that. And so the market prices should reflect that. But I also think that I see in a way corporate engagement also as an alternative to divestment. And I think it's a reality that very many investors are under pressure from their stakeholders to do something. Because it is felt that they have a responsibility, and I agree that they do have a responsibility. And I think that divestment in many cases has been a very visible sort of option that is sort of a signal of commitment to an issue. And that has been very important for many. But I think if you can have more efficient and effective engagement efforts, that could perhaps become a more credible alternative to divestment strategies. And maybe that's better. We don't really want the investors who care most about climate issue not to be engaged with the most sort of difficult companies. Ideally, we would like and from a systemic point of view also, I think we don't necessarily want climate risk to accumulate with those investors who understand the least of it. So I think it's a case for sort of from a more societal or systemic point of view to make sure that the holders of climate risk in the financial system are the investors who are most sophisticated and who understand that risk best. That's from a societal point of view, that's what you would want. So I think there are two different issues. One is the aggregate level of climate risk in the financial system is too high because we have too high CO2 emissions, and that determines the aggregate risk. That doesn't mean that the risk that is there is not distributed in an optimal way. Those are two different questions. And I think we should try to, as we gradually build down this carbon risk by decarbonizing the underlying economy, we should also make sure that we have an efficient system for distributing the risk that is there. And that, I think, the starting point is better disclosure and more engagement.
We have a question from Graham Sinclair, who about greenwashing. And he says, greenwashing is the greatest threat to helping investors move at the speed we need to move to meet what science tells us is telling us for climate. Right. Okay. Net zero, quote unquote, is a quote plastic term. and a boon to greenwashing. How does the PRI and the TCFD approach the challenge and the way reports are made? Okay, not just to offer the perfect cover companies who never really want to change and will drag their feet for the biggest time.
Yeah.
Okay.
So the PRI, our approach is to be a big tent. We want to make sure that we're not just an organization of the sort of 10% best investors in responsible investment, but now with 3,600 investors on board, obviously there will be a mixed bag in terms of how far they have come on this journey of implementing.
Yeah.
We have introduced minimum standards for the PRI. We have started delisting investors that fall below that standard, and we have now made a proposal to our signatories of increasing that standard. So I think this is an ongoing process, but it is, I still want the PRI to retain sort of that sense of being sort of aspirational and not an association just of the 10% best in terms of performance on responsible investment.
Yeah.
I think at the corporate level, we need more reform. We need reform, convergence of reporting standards. I think one of the problems is too many standards that are slightly sort of partly overlapping. The TCFD is trying to combat, this issue with giving more detailed guidance on how to apply the scenario analysis, which we did in November. So I think things are happening.
Yeah.
But yes, it's a risk that is there. I think for the PRI, we want to maintain the credibility of the PRI as an institution and protect sort of them. But on the other hand, I feel, it's a good place to be in that people want to be associated with the PRI and with responsible investment. It would be worse if no one cared.
Yeah.
So let's not forget that.
I mean, just continuing on that theme for a minute. There's another question. It's really about the size of the tent.
Yeah.
Because you represent around about $100 trillion worth of assets, so it's something in that order. But and I don't know if this is accurate, but the numbers I've seen for sort of the total global volume of assets under management is about 150 trillion.
Yes. Well, we would. Our own internal estimates is that in terms of asset under management, we have around half of the global market.
Yeah.
So.
Anyway, it's as you say, it's a lot, and this is obviously a strategic choice to be in reflection, is being that big a tent kind of a strength or a weakness, do you think?
No, it is a strength, but from an organizational, institutional point of view, it has some challenges because it is, of course, more challenging for us to stay relevant to an increasingly diverse group of signatories.
Yeah.
From an institutional point of view, also to making sure that we can communicate in a good way with now, close to 4,000 signatories in between 70 and 80 countries, I think. And we 2 years ago, we opened an office in Beijing and we started recruiting Chinese signatories. Obviously, the challenges that they are facing in their markets are very different than a UK investor, for instance, is facing.
Yeah.
So, but I think that is good. I think that we can, the whole idea behind the PRI is really that investors can learn a lot from each other and that we can collect good practices globally, put them into investment practices documents, and then share it with our signatories. That's what's driving it. I think that we need to have that signatory focus on making sure that we can add value. And I think it's very disciplining for us. We have a model where our source of income is the membership fee that our signatory pays. We have a little grant funding for special projects, but that's really the basis. our funding. And I think that's very healthy because it's very disciplining for us, because if we don't deliver value to our signatories, they will not want to be members and we would be out of business. So I think just maintaining a very strong focus on bringing value to signatories is important.
Yeah. There is a question about sovereign wealth funds, and so Graham Sinclair says investors assessing ESG at sovereign risk in sovereign risk and company risk levels, okay, have a challenge. How do we handle the disconnect, okay, of Norway's sovereign wealth fund abandoning fossil fuels, okay, yet the government of Norway issuing 30 plus new offshore drilling permits, okay?
Yeah, okay, so this is a complicated issue, okay, and I can't speak on behalf of the Norwegian government. I have lots to say on this issue, but I don't think, as PRI chair, that I'd like to go into Norwegian oil policy. But I think, you know, there are some issues there. One, of course, is that the Norwegian oil industry is under the EU system for CO2 quotas, and so and that has a path of decline over time. So any activity within the quota system is an activity that will have to be scaled down to zero over time, in line with the EU energy commitments, which are binding also for Norway. And so that is factored in the analysis of profitability of these assets. So I think it's more that, you know, you have a transition period where actually, if you the natural reduction in capacity from existing investments in oil and gas is much lower. Or sorry, the capacity falls a lot faster than the rate of reduction that is required to meet the 2-degree target. So there, even in the 2-degree target, there is room for some new investment or a need for some new investment in oil and gas capacity. So I think it's more a question of, do we have an appropriate mechanism to ensure that we, at a global level, are investing in those with lowest marginal cost within that total sort of quota of available capacity? These are complicated questions, but it's not like those aspects are not incorporated into the analysis that leads to these decisions. And then you can agree or disagree with the decisions, but
just getting back to the sort of transition issues, and we know that in recent years, sort of public markets have been shrinking at the expense of more private markets. So Jim Whittington asks, how do we ensure that pressure on public companies doesn't just force fossil fuel assets into the hands of entities under less public pressure, such as private equity or state-owned entities?
No, I think that's a really good question, but I think it goes beyond the climate issue. I think this is true for everything that we try to do through reporting, and everything that we try to do on sort of putting requirements on listed companies. And we know that a large part of the climate issue is state-owned oil companies and their transformation processes, where there is none of this sort of external investor pressure. There could be some through corporate bonds, to the extent that they're financed in the bond market, but I think it's, they are largely outside the sphere of influence of institutional investors. So I think it's a very real issue. I think it has to do with how we try to address sustainability issues more generally, not just climate. And if we do that in a way that clearly favors or puts undue burdens and makes the sort of transactions costs of a publicly listed company higher, then I think more investments will just migrate to non-listed forms. And some, I think, would argue that that is one of the factors behind the growth in unlisted, that the cost of being listed is a lot higher due to all of these regulatory constraints. So I think that is a very valid question. I don't have a good answer for sort of what, but I think it has to do with how we legislate and regulate, and making sure that we don't do that in a way that is asymmetric in the treatment of listed and unlisted entities.
Yeah, and in some sense, a little bit the same spirit. Connor Keogh says TCFD asks for forward-looking statements. Will directors easily accept the potential liabilities, for statements which inevitably have a lot of uncertainty surrounding them?
So this is a very key question. We said that our recommendation was to include this in financial filings. We obviously had lots of long discussions on this, how this interacts with legal requirements and also across jurisdictions. There is a threshold of materiality, but the concept of materiality is not defined in the same way across sort of common law, civil law countries. And I think it's also a question of how this relates to, an impairment assessment of assets. So if you're under IFRS or other reporting frameworks, US GAAP, doing an impairment test, and they have to discuss sort of, well, how does your scenario testing, if you're an oil company, for instance, relate to the impairment testing that you're doing of your assets in the oil in the ground on in your balance sheet. So there is some guidance on this in the materials from the TCFD, and we have tried to address this. And I think there are ways that this can be done, which doesn't conflict with existing regulations and all of these sort of institutional, different institutional obstacles, if you like. So a valid question, a difficult question. I think, without being sort of an expert on this particular topic, that we've found workable ways to address this. But this has certainly been very high sort of on the agenda, and through the TCFD meetings and trying to come to this, we had very long discussions on those issues, and brought in lots of outside experts, et cetera, to try to understand these issues. So, but I think, sort of looking practically at it, I don't think that has been the main constraint on why companies haven't reported. I think the main constraint is that it is difficult. It's analytically very difficult to do the exercise. And I think that has been the constraint more than some of these other issues.
Martin, I think we've time for just one more question, if that's okay. This comes from Rui Suarez, who wants to know about banks and the way they report.
Yeah.
He says, banks may have very, very good ESG and carbon emission scores on the surface, but if their credit books are highly exposed to low ESG, high carbon emission borrowers, then banks, good ESG carbon emission citizenship would be, he says, fake, wouldn't it?
Absolutely. So the TCFD framework obviously applies to banks as well, and there's also been an initiative that the PRI, well, actually it's a UNEP-FI that is sort of a sister organization to the PRI, has set up this so-called Principles of Responsible Banking, which is sort of a parallel organization to the PRI. We don't have banks as signatories to the PRI, only, of course, asset management activities that they might have, but not retail banks and sort of. But there are now a number of banks in this initiative, Principles of Responsible Banking, and they have issued guidance on TCFD reporting for banks, and also reporting on how TCFD reporting from corporates can be included in the sort of credit process of banks. Yeah. So a very important issue. I think a very important issue also for investors who typically have maybe 3 or 4% of their portfolio in the oil and energy sector and 20% of their portfolio in financial companies, to understand that a lot of the climate risk that we're seeing will, in the end, be in the financial sector. And so if you're an institutional investor, understanding climate risk is not just about what will happen with the 3-4 whatever percent you have in the energy sector, but really how climate risk can affect the value of all your investments in the financial industry. So I think this is something that investors should really care about if they care about climate risk.
Martin, thank you very much indeed. It's terrific to hear from somebody who's had such a central role in what has been going on in the PRI and indeed narratives over the last few years. So thank you very much indeed for making the time, and indeed thank you very much to all the other speakers who joined us today, and to our audience. We hope you found this event useful, which was organised by the AQR Asset Management Institute at LBS and also by the Corporate Governance Institute. There will be recordings of today's sessions made available. This will go on our website in due course. And with that, it just falls to me to thank you all once again for contributing, and to wish you all a very good afternoon. Thank you.